$334 billion. Sit with that number for a second. That's not Berkshire Hathaway's total portfolio value. That's not their market cap. That is the cash and treasury bills Warren Buffett is sitting on right now. The single largest cash reserve in Berkshire's entire 59-year history. Larger than the GDP of Finland. Larger than the market cap of every company in the S&P 500 except the top 7. And Buffett didn't stumble into that number. He built it on purpose. So the question every serious investor should be asking isn't what is Buffett buying? The real question is, what does $334 billion in dry powder tell you about where this market is actually headed? And what should you be doing about it? Here's the pattern most retail investors completely miss. Over the last 2 years, Buffett hasn't just been cautious. He's been systematically raising cash while the market was celebrating new all-time highs. He trimmed Apple. He trimmed Bank of America. He let positions run off without replacing them. That's not fear. That's preparation. There's a specific logic behind every move he's made since 2023. And once you understand it, it reframes every market headline you'll read this quarter. Because Buffett isn't sitting on $334 billion because he's scared. He's sitting on it because he hasn't found anything worth buying at current prices. And that distinction? That's everything. Warren Buffett took control of a failing New England textile mill called Berkshire Hathaway in 1965. And turned it into a $900 billion conglomerate through nothing but disciplined capital allocation. That single fact tells you everything about his philosophy. Buffett doesn't chase momentum. He doesn't trade macro narratives. He finds businesses with durable competitive advantages. What he calls moats. Run by capable management, generating consistent free cash flow. And he pays a fair price. Then he holds. Not for quarters. For decades. His framework is almost insultingly simple. Buy wonderful companies at fair prices. Then get out of the way. But here's why that framework matters right now. In this specific market environment, the S&P 500 is trading at price-to-earnings multiples that haven't been this elevated since the dot-com era. Rate cuts are being pushed back. Commercial real estate is still under stress. And yet the headlines keep screaming about AI-driven upside. Buffett has seen this movie before. Multiple times. And every single time, his response has been the same. If the math doesn't work, he doesn't buy. Period. So let's talk about what Buffett actually owns. And what each position signals about his conviction. But the trim is the tell. Buffett doesn't sell wonderful businesses lightly. The fact that he reduced Apple, a company he publicly called the best business in the world, suggests one thing above all else. Valuation discipline wins over love for a story. When price gets ahead of value, even Buffett takes chips off the table. Now look at American Express, AXP, and Coca-Cola Co. These aren't trades. These are permanent holdings. Berkshire has owned Coca-Cola since 1988, American Express since the early 1990s. Both positions have been held through Black Monday, the dot-com crash, the 2008 financial crisis, COVID, and the 2022 rate shock. Can you guess what those two positions have in common? Pricing power. Both companies sell something with brand loyalty so deeply embedded that they can raise prices without losing customers. In an inflationary environment, or even a post-inflationary one, that is the single most valuable characteristic a business can have. While retail investors were panic selling consumer staples in 2022 because rates are rising and growth is dead, Buffett was collecting dividends from Coca-Cola that now yield over 50% on his original cost basis. That's not a typo. More than 50 cents of annual income for every dollar he paid in 1988. Then there's Occidental Petroleum, Oxy. Arguably the most interesting active bet in Berkshire's current portfolio. Buffett has been accumulating Oxy aggressively since 2022, now owning over 28% of the company, plus warrants. He's also received regulatory approval to acquire up to 50% if he chooses. This isn't a passive investment. This is a strategic stake in America's domestic energy production capacity. Buffett is betting that oil demand doesn't collapse on the timeline Wall Street's ESG narrative suggests, and that domestic producers with low break-even costs will generate enormous cash flows for years to come. While institutional investors were rotating out of fossil fuels to hit ESG mandates, Buffett was quietly becoming one of the largest individual stakeholders in American oil. And then there's Moody's, MCO, the holding most people forget about. Berkshire has owned Moody's since it was spun off from Dun & Bradstreet in 2000. It's essentially a toll booth on global capital markets. Every bond issuance, every corporate debt transaction, Moody's gets paid. It requires almost no capital to run and generates extraordinary returns on equity. That's the Buffett model in its purest form. Find the toll booth, buy the toll booth, never sell the toll booth. But here's what most analysts aren't saying. Buffett's $334 billion cash position is a double-edged sword. And the bear case against his current strategy is more credible than his fans want to admit. Here's the risk. If the Federal Reserve engineers a soft landing, if AI productivity gains are real and accelerate earnings growth, and if the market continues to grind higher through 2025 and 2026, Berkshire's massive cash pile becomes a massive drag. Cash sitting in T-bills at 5% sounds great until the S&P 500 returns 20% for the third consecutive year. Several prominent hedge fund managers, including those running momentum-driven systematic strategies, are actively betting on the opposite of Buffett's positioning. They're long technology, long AI infrastructure, long the narrative that this time genuinely is different because computing power is compounding in a way that rewrites corporate profitability models. Buffett's single biggest portfolio blind spot right now: artificial intelligence. He owns none of the Magnificent Seven except Apple. And Apple's AI story is still largely aspirational. If AI reshapes economic productivity the way bulls claim, Berkshire's portfolio of banks, energy companies, and consumer staples could massively underperform for a sustained period. Buffett himself has acknowledged this. He doesn't invest in businesses he doesn't understand. That intellectual honesty is admirable, but it also means he's potentially sitting out the most significant technological value creation since the internet. So who's right? Here's what the data actually suggests. Buffett wins if valuations mean revert and the AI earnings story disappoints. The momentum crowd wins if AI transforms corporate margins faster than history says is possible. Right now, Buffett's track record across 59 years of market cycles carries more weight than a 3-year tech rally narrative. But the gap between his performance and the index is real. And it's widening. So what does any of this mean for your portfolio right now? 3 specific implications. And here's the question that keeps this story open. Buffett is 94 years old. Greg Abel is already designated as his successor. Does Berkshire's investment philosophy survive the transition? Or does the next generation of leadership quietly drift toward the market in ways that fundamentally change what Berkshire is? That's not a hypothetical. That's the most important succession story in American finance. So here's the real question. Buffett's $334 billion cash pile is the single smartest risk management move in the market right now. Or is it a generational opportunity cost that proves even the greatest investor eventually loses his edge? Drop your verdict below. If this breakdown gave you a sharper framework for reading institutional moves, Hit that follow button, because the next video answers a question that should keep every equity investor up at night. What happens to S&P 500 valuations if the Fed doesn't cut rates at all in 2025? The answer isn't what consensus expects. You need to see it.